We're looking for earnings to recover to about 14% growth, which is about roughly the average level in 2015. The key reason for that is the right side chart, which shows the connection between the capital expenditure cycle and the profit margin cycle. And the key point here is that as you get more discipline in capital expenditure, the way we've drawn this chart is that when the lighter blue line goes up, it means that people are investing less in their capacity expansion. Then with a lag of about 1 to 2 years, we see profit margins begin to recover. And that is the key driver for our 14% earnings growth expectation in 2015, which we think the stock market will begin to price in the second half of this year. And so we have two ideas that we've been espousing. One of them is liking global cyclicals, and we show here the relative performance chart of global cyclicals versus property stocks. And the basic idea is that we're playing the improvement in growth, and we're being less exposed towards the parts of the market that are more interest rate sensitive and therefore asset price inflation sensitive. The Europe line is the bottom line in dark blue. The US line is the top line in light blue. The key point is that, of course, we like the theme of stocks that are exposed to the US, but we note that those are up about 40% in the last 2 years. So that's been better priced in the stock market. Whereas the theme of a recovery in Europe is less well priced. Those stocks have basically gone nowhere for the last 2 years, and they're delivering on average about 20% growth this year and trading at about 14 times earnings. So we think the growth versus valuation story is better for the Europe exposed stocks, and the entry point is better because they really haven't done very much the last 2 years.
So generally speaking, as Tim mentioned, we're looking for 7.6% GDP growth for this year. That's very similar to levels that we had seen last year. In terms of path, you'll see that probably the year-on-year growth rates are a bit higher in the first half of the year and a little bit lower in the second half of the year. That's largely because of base effects and doesn't really reflect any kind of meaningful sequential growth slowdown in the second half. We also expect the consumption to slice to accelerate slightly and somewhat allow investments to decelerate to a certain extent. So clearly the market has been quite worried about investments dominating GDP growth. We do see that this will reverse to a certain extent this year. Well, we think that there is a tactical buying opportunity here because one, as you saw from our earlier slides, our economics view is one that's fairly favorable. We think that growth will still be relatively stable, and we think that the composition will improve incrementally versus last year. So that's actually suggesting that we can have decent growth without a lot of structural sacrifices. Our overall HSCEI index target for the end of this year is 12,000. You can see from the bottom that that's going to be partly from earnings growth and partly from valuation change.